Well, good day, everyone. David Phelps back again with our Real Wealth conversations this week. And today I'm pleased to have a good friend of mine, a long-term mentor, Mr. Alistair McDonald with us. Alistair, thanks for being here.
It's a pleasure to be here, David. I always enjoy our conversations, and I'm pretty confident this one will do the same as it always does. Triggers my own thinking.
We have enjoyed many conversations over the years, and one that we have not just recently, but for a number of years have been watching the market cycle, the long-term secular cycle, 40 years going back to 1980, where interest rates were all-time highs, with Paul Volcker trying to knock down the inflation of the 70s, in which he was successful with back-to-back recessions. We went through that period, and for 40 years, we saw interest rates over time go from that 20% federal funds rate all the way down to zero in the last 4 years. And those tailwinds provided a lot of opportunity for those who had the means and the desire to build something, build anything of value. Didn't have to be particularly special, but it was enough value that people could do relatively well. We have, in my opinion, I think yours as well, we've turned a corner. I know you've got some stats to provide today to back that. Why is this important for many of us and those who are listening to us today? Anybody who is either an investor in the capital markets, the private markets, or an investor and owner in their own equity in a business or a professional practice. These are the conversations that I think are really at the forefront, because the models that we've seen that have, I say, worked because of the cheap debt over many years, and the propensity for that model to cause a financialization of assets. Not by financialization, it's the arbitrage. It's using the cheap debt to create a speculative environment with a lot of liquidity in the marketplace. Money chases yield, speculators jump in, and we've had these years of fast turns. Build value, build equity somewhere, and there's someone there who will take it off your hands, give you a nice multiple exit, and take it on and maybe consolidate, aggregate more of the same, and sell it on, and so forth. And that really started back, as we've discussed, in the 80s. The corporate raiders, as it was called. Today, it's called private equity. Better term for those who want to be more prudent about their investing. And in dentistry particularly, it's certainly not a sector that's by itself been looked at by private equity. It's one of many sectors, but certainly there's reasons why dentistry became a bullseye target in the last half a dozen years. And yet we've seen the change in the interest rate environment due to many factors we don't really have to get into today. Just the fact that interest rates have risen, we have inflation that's remaining steady, and maybe there's some signals within all the noise. I know a couple that we've looked at in the last few months is some of the institutions, Harvard and Yale, are for some reason selling off their private equity investments at discounts. I'm going to stop there with just that intro. I will also say that to my friends in the audience today that don't know Alistair. Alistair comes from a very storied background. He's not just a historian, but he's lived through history. He's lived through the dynamics, I'd say far greater, more volatile dynamics than we are maybe experiencing here in the U.S. today. So with that context, Alistair, I'm gonna hand it off to you, and let's build from this and bring some conversation to the table that I think is missing in our space. Unfortunately missing, and there's many people that may be falling into a realm of a position that they didn't hope to see themselves in after many years of hard work in building something of value.
Yeah, it's really well said. I think all of this is captured well. Fair weather sailors are revealed in a storm. And I think of certainly my own experience. You're absolutely right. I would choose the complexities of the DSO marketplace today, any day of the week, over 18 million% and inflation and 140% interest rates back in my home country during my own entrepreneurial years there. So yes, this feels so much easier. The handle of the whip is much easier to predict than the tail of it. But I think well captured. A mutual friend of ours just recently, in the last week, posted something on social media asking his audience, which is in the real estate space, what is the number one trick, or what is your number one word of wisdom about how to make money in real estate? And everybody jumped in and they said, you've got to have your operations down, manage your overhead, know your area, know your tenant, whatever that, manage cash flow. And I gave my own answer, which is time your career inside of a global 40-year decline in interest rates, and then nothing else really matters. And it's true. We have enjoyed, as you've alluded to just now, and as you've spoken about for years, a period of time where it didn't really matter how bad of an operator you were, you could consistently refi yourself out of either bad deals or bad ideas or good deals that went bad, or it doesn't matter what it was. Cheaper capital was always there to save you. And that has changed. And it's changed meaningfully, just as you and I were anticipating back in 2020 and 2021. Meaningfully. It's not just that rates have gone from 2.8 to 7 on mortgages. It's the rate of change and the scale of change that is without precedent. It is quite literally without precedent in American history. And I give an example. We look at, say, August of 2020, the rate on the US government 2-year was at 0.1%. Fast forward just shy of 24 months, it was at 4.9%, a 49x increase in the cost of capital. Very few individuals and industries can survive that sort of change. So change is upon us. The problem is when we bring half-cycle business models into a full-cycle world, and that's what private equity is being revealed for. There's so much here that I think needs to be addressed, because to understand history is to be able to anticipate the highest probability outcome. But nobody wants to understand history, particularly in the DSO space, because we are so exceptional. You don't understand dentistry, ... No, but there's a lot of money coming into dentistry, et cetera, et cetera. That's a statement of fact masquerading as a forecast. This is critical. People say, yes, but there's a lot of money coming into dentistry. There was a lot of money coming to dentistry, and it's not a lot anymore. Even if we say it still is, that is still not a forecast for the future. Jeremy Grantham made this point very well. Every time in this investment committee, somebody said, NVIDIA is really popular right now. He would say, is that a forecast? Is that a forecast? Interrupting his team to separate the difference between a statement of today and a projected linear extrapolation into the future. That is where the docs that you and I both love and serve are at the greatest risk. What was, assuming it always shall be, yet we know that's not true of interest rates. So the very model of private equity was rooted in the early 80s when we first started seeing declining interest rates that you just mentioned. That meant that for the entirety of its history, private equity has not just been able to survive falling interest rate environment and the asset boom that inevitably follows, but it is in fact the entire system is built on the expectation and need for ever-going access to cheaper or equivalently costly capital. That is over. It's a half-cycle business model meeting a full-cycle world, and really good people are going to get caught up in it. Before I say anything else, I can be misinterpreted routinely for being anti-DSO. I'm absolutely not at all. I myself sold my own hospital to a private equity group. I'm not, what I'm against and what I'm cautious of for the docs I serve is bad deals. And as capital gets more and more expensive, as a matter of fact, as a just implicit truth, deals get worse or good deals get harder to find.
The terms have to change, and they have changed, and that's what unfortunately we've really built or created a generation. And when I say a generation, I'm just looking back, let's say over the last 15 years, a generation of people that look at their experience with recency bias. Well, it's always worked, and there's always proponents and pundits that believe in a model that did have some sustainability for the reasons that we've discussed, primarily, cheap capital, a lot of liquidity, money chasing yield, to prop this model up. The question today is, and we're bringing to the forefront, is this private equity backed, and just going specifically to dentistry, DSO model, is it sustainable with these higher rates? And you've seen firsthand the change in the structure of these deals where the risk has been definitely transferred to the seller. And the seller ends up holding major portions of risk without any autonomy, without any authority, but all the obligations and many liabilities that they didn't understand they were getting involved in.
Yeah, that's exactly right. And to your credit and to my gratitude, for which I'm grateful, rather, you and I have been talking about this for years. I was just reminded recently of a podcast that you did, and I had the privilege of speaking with you on February 23rd of 2023. I think it's episode 420 or something, which is kind of an interesting number. That's talking about the pitfalls of exits in a rising interest rate environment. That's now 2.5 years ago. Of course, at the time, as has been the case for you and I routinely at market turns, nobody wants to hear about it. But now everybody's seeking to understand what's changed. What's changed is the term apocalypse comes from the Greek apokalypti, to be revealed. What rising capital has revealed in this apocalypse, this revelation, is the structural nature of two things: how they make money and how they protect and assure that. How they make money, the use of debt and leverage, leveraging your asset. And if you're the doc and you're selling your practice and you have an employment contract, your practice is not being sold. You are, of course, the yield. The practice is simply the vehicle that delivers it. That's what's changed. How it's changed, what else is being revealed, is how incredibly sophisticated, tip of the hat, private equity is in structuring agreements so that it's heads I win, tails you lose. Or heads I win, tails you may lose less. If all goes well, either way, I'm going to get paid is the point. They will never get out hurt. In fact, it's not even their money. Statistics show, Bloomberg will show this quite clearly, that on average 3% of a private equity fund is actually the partner's capital. The rest is outside investors, completely seduced, just as too many docs are, by the opportunity to invest in private equity. The idea of the mystery and seductive powers of the term private equity is a siren song that is pulling many, many ships onto the rocks.
And the debt structure, Alistair, which has come to the forefront, across many industries, certainly in the real estate markets, we've seen the headwinds there in terms of the use of short-term debt, high leverage that again worked when interest rates were low, but now the interest rates have risen. We've seen that occur. In terms of where this goes, and looking at the debt structure, many sellers of practices don't understand that, as you said, they're the ones that are being traded, the exits on them, and to produce the pro forma proposed yields to everybody, that debt has to be used. I mean, debt is the leverage point that investors have used forever. But if it's used incorrectly at the wrong time, at the wrong rate, on the wrong terms, then the risk factor rises exponentially. And unfortunately, many of our colleagues, with all the best intentions to make a prudent exit at the right time, don't understand that they're behind. Their position, their equity, their payout, the buyout at the back end is all predicated on this debt being managed. Well, if it's not managed, then the back end equity is gone. We've seen it. It's happening today in, again, many sectors, not just industry, not just real estate, but wherever private equity is today, we're seeing the fallout of the companies that they have aggregated, consolidated, leveraged those assets, and then sold off much of the best assets just to recapitalize back into their pockets.
Yes, and they're discovering just how subordinated their position is on the capital stack. I joke, there's a funny thing happened on the way to the IPO. For the late teens, we kept hearing about we're going to go public and this grand goal to go public, which peaked in 2021. The spike in IPOs, the all-time peak to date, was in 20, which coincides perfectly with bottom in interest rates. They bottomed at different rates between the T-bill and the 2-year and the 10-year between 2020 and 2021. That throwover, as we call it from technical analysis, represented the final burst of opportunities that certain DSOs had to go public. But then once interest rates had visibly turned up, the equity that you're referring to that private equity used to sell and reimburse themselves for was no longer there. So what happened? Well, we went from exit and sale to recap. And this is one of the most insidious and critical points I think that your audience should know about. I think that it is on us to shout this from the mountaintops. What has happened over the course of the last 3 years is, given that there's no equity and no buyers for them, there's a reason. You mentioned Harvard is selling their assets. Oddly enough, they started to sell their assets at a discount and then stopped because there was no bids at the price that they needed to justify the claims on their balance sheet. So what did they do? They went from trying to sell $2 billion worth of assets, a large portion of their $45 billion endowment, to $1 billion that they borrowed money against. Why? At its core, the real danger is the secrecy of a private shadow market. That's how private equity operates. None of these assets are publicly traded. And those that are, like the stock price of KKR and Apollo and so forth, can serve as proxies for us to get a sense of the claimed value of our mark-to-book claims of our private equity position versus the mark-to-market price of the actual share price of KKR, Apollo, Ares, etc. And the gap is huge. The purported value of the private companies is significantly higher than the actual value of the public ones. What's that about? What that is about is the world coming to terms with the real risk premium of illiquid assets. Nested inside of that, we have docs that have sold their baby, their lifelong practice, business, the nugget of all of their work and gold that they've saved, to a company. Well, look, take a step back. You and I both know the only difference between a good investment and a bad one is the price you pay. If I buy a rental for $100,000 that spins off $12,000 a year, I'm going to get a 12% return. If I buy the same unit a year later for $200,000 and the same return, I've got a 6% yield instead of 12, meaning the more I pay, the worse my return. We know this, but we forget it when we are seduced by the promise of an eternally higher recap figure, or now recap, used to be exit figure. And what evidence do we have of that? Well, it's sitting in column H59 on the Excel spreadsheet from the private equity. There's no claim of value for that. So what happens is these individuals shift from getting an actual sale opportunity to a recapitalization, which are also really more honestly referred to as a shareholder dividend recap, meaning that
let's explain that, because I think there's a lack of understanding of where these dividends come from. So the idea was to exit, to sell the equity, to return dividends. But what we're saying today is because there's no buyers,
there's no bid for the equity.
Yeah, so for the equity. Yeah. So now it's going to the shadow banking private credit markets and refinancing, adding more debt. That's the recap. Recapitalization is adding more debt. So it's not an equity sale. So I just want to make sure people understand that, because the nuance there, I think, it's very important. People don't understand it. They still think, well, this is all working because I still got to check. It's all the same, and it's not.
That's exactly right. And this is where I'm going with this. The risks and dangers become more and more obvious as you see them stacking up. So we've gone from selling to saying, well, okay, we can't sell it, but we can go to private credit, the shadow banking system, and say to them, we've got a valuation of approximately X. Well, can we borrow against it? Private equity is now bailing out private credit. This is a whole other mutation coming out of this low and now rising interest rate environment. So I've sold my practice to a group that assured me we would get an exit. We didn't get the exit, but good news, we're going to get a recap. Now, I've also had to, if I went through the deal, had to leave 30, 40, in some cases 50% equity retained inside of the practice. What does this mean? It means that I sold to a group. I've taken 60 cents on the dollar for my practice, sold 60% of it, retained 40% in the practice, and continue to reinvest with them by leaving that retained 40%. Going back to the principle of what you pay for an investment dictates the return, I know that I'm going to get mathematically a terrible return. How do I know that? Because I sold to them. How do I know it? Why did I sell to them? Because they overpaid. Mm-hmm. Docs are selling because these people are overpaying for their practice, meaning they're paying more than any competitor down the street will pay, and that's why we sold. No problem, but they're not sales, they're partial sales, and the retained equity that stays in there is now trapped. You have an illiquid minority position in an asset over which you have no control. No problem. The masters of Wall Street have got this all figured out. They then take this asset, borrow against it. Now we've got an elevated price, an excessively high valuation. We know because we sold to them for that exact reason, being borrowed against, and this is a cause for celebration. This is so incredibly manipulative. And whether it's deliberate or accidental, the net result is still manipulation of understanding of so many incredible docs that didn't go to finance school. They didn't work on Wall Street like I did. They haven't seen the other side of this trade. With all due respect, they know as much about that as I do about a root canal. Mm-hmm. I'm just not qualified to do it. So I yield to a dentist's wisdom. They are doing the same here, overlooking the fact that the yield will be derived by their hands, not by some magical exit in a post-IPO peak world of 2021. To finish the point, what do these recaps look like? Well, there's a front stage and backstage. The front stage this is a huge celebration. Heartland Dental is one that's being pointed to by brokers and private equity as evidence of this model working, because the recap took way longer than it should have for them to borrow, and they finally found funding to do it. What nobody speaks about is that recap pushed Heartland's S&P rating to a B-, which is marginally, that is a distressed asset level, which is to say this is a company at high risk of default. That's the celebration. Another large operator that you and I both know, a company that many consider to be the best operator in the space, one that I had championed up until 3 years ago as being a good example of an operator versus an aggregator, themselves completed a recap at the end of last year at 14%. Just before we spoke, I pulled up current ratings and what 14% would suggest. 14%, according to Moody's, dictates that this company, which I won't name, is at a heightened risk of default, is considered a distressed asset or a non-performing asset. That is the backstage. This is the reality. So we've taken an overpriced asset, filled it to the gills with debt to recap and pay back the private equity partners, and done it at 14%. Distressed debt levels, all under the claims of dental practices are so safe. This is why if they were safe, they wouldn't be tagged as distressed assets and paying 14%. This is the tragedy. Now, again, the front stages, what a triumph. The back stages, we'll pay any interest we can to get our big checks because we're not going to pay any interest at all. The practice is. Right. The profits go to the partners, not the docs, because they have equity positions. They're not going to be paid out of debt. If they're lucky, some of them might, but most of them are not. Now, what does this mean? The net result is this practice is burdened with a debt load that is unsustainable. And S&P and Moody's are saying that. In the case of Heartland, they said this company is at serious risk of either increased competition or any sort of failure for a rise in rates. You show me a doc on reimbursement rates. You show me a doc who's successfully raising their reimbursement rates with an insurance company or getting it. It's not happening. As for the competition, it's everywhere. I think this is serious, and I wish it wasn't true.
Alistair, do you believe universally that there is any kind of a prudent deal to be had, not naming any PE-backed DSO by name, but is there a deal to be had today? Could it even be structured to mitigate the risk? Or maybe another way to pose this question is, you sold your hospital in 2021, I believe. Yes. at the peak where interest rates were still low and the multiples were there, and you got a check on the front end, not a play on the back end. Those days are over for sure. But in today's environment, do you think you could take your hospital as it was then, and with the EBITDA number that you had, and would you even consider a private equity deal today? Do you think you could get it done in a way that would print, or would you find another way to take an asset, a hospital that you built through the value add and the culture and the practices and the systems that you put into place to create real value? Would you find another way to perhaps hang on to that business and not try to make some exit that wouldn't happen the way you wish it would?
Tragically, that hospital that I bought in 2015, that I sold in 2021, I bought a one doc, 3 days a week practice, sold a 6 doc, 24 days a week practice for 23 times what I paid for it, 15 times EBITDA, as you say, for a check. Nothing amazing about me. I saw this hot money coming into this particular space, as it was in dentistry, and they have successfully turned this 8,000 square foot facility with 6 full-time docs into a part-time 2 doc practice with EBITDA having imploded 80% in the last 4 years. This is the nature of private equity. And of course, my heart breaks for those employees and docs. To your question, though, the idea that the same money is never made twice. In my investing years, I've never seen, going back 26, 27 years, I've never seen the same money made twice durably. I mean, you might catch a bounce in something, but it's not the way to bet. Consider that it took the NASDAQ 14 years to get back to its peak of 2000, as an example, by which time everybody had left. Nobody believed in Amazon when it had fallen 98%, only to see it come roaring back. The same money's never made twice, which is to say, if I were to go back, it would be, as is going to be on offer for too many docs today, to go back, buy back my own hospital at pennies on the dollar. But I don't catch falling knives. And it would need to be, unfortunately, a type of distressed deal for it to be priced accordingly. The valuations that they were willing to pay were so astoundingly ridiculous that I sold to them. From those preposterous expectations, which is what valuations suggest, would be, it's a long way to go before we get there. But that is unfortunately what I see as being the next half cycle. Docs taking back their practices. The real, not to say that deals aren't being done. You and I know individuals in common, clients in my community that I've helped them have done about 320 million in exits in the last 2 years. A whole different level of sophistication is being brought to these deals that include personal promissory note bypasses, which are being plugged into a lot of deals. That's something we should speak about. Put options, et cetera, et cetera. There's a number of tools that I'm bringing to the docs I'm advising to bolster their position, to try to give them the same level of assurances that private equity gives themselves. That's difficult to do. Because
that's what I was going to say is those tools that were, those who knew about them were which you discussed, plug those in at a time when private equity, with their sophistication, were still willing to do, because they wanted to get the deals done.
Yeah.
My question to you, and this is where I don't have the insights, but are people able to negotiate those same practices inside those agreements today?
They're not.
I would say I would guess not.
They're not, in an interesting way. They'll say, for example, there'll be slight modest changes that look like nothing to the naked eye, which is, okay, we'll give you a put option at 90% of current valuation. They're not doing that anymore. But let's say we'll give you a put option at 85% of current valuation, but our EBITDA expectations are not 90% of what you're at. They're 98%. So we'll pay you less, but we expect more. It's almost that thing of, we'll give you what you want if we're going to take more over there. So, I share with clients all the time, it's worth remembering, the largest line item on private equity. You notice they don't have a marketing budget or advertising. you don't ever hear get in now to this great Apollo deal. It's pure myth and mythos, and that gathers assets, and the exclusivity of it, and you're special. That works enough, like an overpriced restaurant. They don't. The largest line item on their P&L is legal, for a reason. So as sophisticated as we've been able to be with my clients, we can't compete with an army of full-time professional attorneys in New York. You know,
you mentioned the promissory note bypass. Just out of my curiosity and reference for others who are listening, can you explain that?
One of the most haunting inserts that I've noticed in the last 18 months, and it's not common, but I've seen it twice, which is enough to anticipate more of this, is private equity putting promissory individual, so let's say I buy out your practice, but you own your 40% in an LLC, bypassing that with a promissory note that you have on what it is that you're supposed to generate for me, almost a personal promissory production guarantee that you make for me outside of the LLC expectation. This is also showing up where individuals are to do with, they own the building, and they'll say, well, okay, but basically we're going to do this, but it's going to cost us some debt to do it. So we want, they're bypassing the corporate structure, the practice purchase, to anchor some of their securitization onto the building as well, even though you own the building separate from the dental practice. So I mean, they're quite literally draining the blood.
They're just cross collateralizing, adding more collateral.
Exactly.
And also a promissory note with basically a personal guarantee on.
Yeah.
Wow.
Personal guarantees on it may be the rent because they own that. Personal guarantees on certain level of net production. I've seen 2 of those situations just in the last 18 months. Not a lot, but the fact that it happens at all and individuals have agreed to this is just haunting.
And you know, most of our colleagues, you know, have licensed advisors. I mean, certainly, I don't think anybody would walk into one of these without an attorney. But is it just still the hype that has been built over all these years that even well-versed attorneys would just kind of let this kind of go without advising a client, because the client is trying to make this exit on the basis of this grand multiple that they've never seen, the figures like that in their life. Of course, when you net it all out at the end and what you get on the front end is, you know, it comes down to very little. Then you have all the liabilities on the back end. But the whole idea in building something of value, I guess if you can make a big enough exit and make it happen, and that serves your purposes for life and gives you the sovereignty, the freedom, the options that you want, then good for you. But that's failed and is failing. And I think what people are doing is they're trading these expectations of grandeur of this big exit and trading their own sovereignty for that expectation.
One other aspect I forgot to mention just while we're talking about promissory notes is those clawbacks. It's not uncommon for individuals to be paid. So your LLC that I buy gets paid is to have the clawback bypass the LLC and go back to you individually. So you can't take that money out of your LLC and, you know, buy a rental property. They'll come around and hit you up personally. The clawbacks are quite literally wrapping around all of the assets that this person could net out from a transaction. Of course, perfectly legal if 2 people agree to it.
Sure.
You know, but to the point of mediators, you know, who could possibly represent us? What I see is with, you know, there's good people and there's bad people. There's good people doing good business, bad people doing bad business. And then there are individuals that were doing good business, but the industry itself has shifted and they're not necessarily at fault. And this is the case for some brokers. We have this idea that the broker is going to represent both parties. Are they?
Yes.
Are they really? If what I'm selling as a broker is not just your practice, which is a transaction, that's an event. It happens on June 1st, what have you. But I'm actually selling you with a 3, 5, and most recently I've seen instances of a 7-year working commitment. I'm not just selling a practice, I'm selling people. And I am being paid now on the future valuation of your contribution to the practice. I just did a whole recording on this called Dentistry in a Time of Human Trafficking. I realize it's a fairly provocative title, but that's what's happened is we have moved from, if a practice sale is predicated on, which is an event, on a process of a unbelievably durable employment contract that extends years out into the future, then I didn't buy your practice. I bought you. Worse than that, some of the most, and I'm going to use this term because I believe it to be true, parasitic mediators and brokers, which are out there, they're not all like that, but they're out there, are quite literally demanding payment now on the future valuation of the purported recap, and they're getting it.
Wow.
They are getting paid at the time of the sale on the value of the future recap. This is very much like me being a realtor that sells you your home, makes 5%, but makes an additional 5% when you sell this $500,000 home for $1 million in whatever point in the future. This should be.
But you're not even waiting for that $500,000 home to get to $1 million. You're saying it will get to $1 million.
Don't worry about it.
Give it time. I'll just take my check now. Thank you very much. Have a great life.
Yeah, it's dentistry. What could possibly go wrong? It's housing. It never goes down.
All right. Well, we better wind this down. Let's wind it down this way. Let's summarize, Alistair. And we've laid out a lot today, a lot of concerns that I think people should look at. Any other red flags as those that we have the privilege to serve in different ways are making considerations right now? Red flags, or just a summary of how they should be more discerning about the deal structures they may be getting involved in?
Yeah, this is an issue because what's happened is as these deals have stretched out to include years of purported future benefit, we've extended the timeline whilst making claims in a moment. So we've priced out a process but sold an event, if that makes sense. And so what happens is it creates a complete perversion of incentives, if not a perversion, a distortion of incentives, such that an attorney is going to look at the contract and say, okay, just so you know, you have to do X amount of production every year for the next 5 years. Are you good with that? I don't know. Attorneys are clearly not doing this. I have the disgusting experience in the most recent couple of weeks with one particular, he's the CEO of this DSO group, who told my clients, we don't have time for attorneys. There's no time for them. We've got to just get this recap signed off on. When you hear that, talk about a red flag. Outside of that, so what's happened is the entire industry has distorted the incentives, and individuals, well-meaning, honest, hardworking docs, think everyone who's honest thinks other people are honest. Everyone who's dishonest thinks everyone else is dishonest. You have these well-meaning docs that are taking them at their word and being seduced by the promise of this monstrous check that they would never pay for their own practice that they know better than anybody. What's that about? Doesn't make any sense. What do we do? The point is, this extension of risk is not noticed, and we are left only with individuals that profit from the transaction, not from the lived experience of the doc. This means there are no advocates left. There are no advocates. A true advocate is somebody that's willing to say, a realtor that says, I don't think you should sell this home, or I don't think you should sell it to them, or I don't think you should sell for that price. But there's nobody out there that's going to do that.
No. Well,
the beauty is we sit on assets that we've built and designed. Nobody is more qualified to adjudicate their value than us. The challenge is we have to ignore the siren sounds, the wax in the sailor's ears, and decide what our journey is, unfettered and unwavered by outside signals of other people that have done so well. The people that claim to have had great deals, either those deals, like my own, happened in 2021. Anything since that time is a partial deal with a bigger future promise. How many people do you and I know that have truly exited, which is to say they own nothing of their practice anymore, that got the multiples that were being claimed?
Still waiting. Still waiting.
At some point, the future has to arrive.
Right. Well, I think this will allude to more conversations, and we'll be having many of these at the Real Wealth Conference we'll be hosting here in Dallas in October. I believe, Alistair, and again, this is within discussions that we've had with ourselves and with our respective tribes, in that building something of value, and again, we're talking about professional practices today, should be looked at today more from the fundamental operations of playing a long game. The short game, I think, is, for the most part, is over, at least for now. And so building something that you would like to keep, make better, build into whatever lifestyle that you enjoy, but playing for a quick exit, a big multiple, I think we've got to change the dynamics of that. And for a lot of people, I know that's not what they want to hear. It's news they don't want to hear. But I think adjusting one's mindset and understanding there is a way to build a business, to craft a practice that you can enjoy and not feel like you have to make some big exit until you're ready. Until, and certainly when you're ready to make it, and there's appropriate ways to do that. But the way it's been done in the past, I think, has become a model of the past, and I don't see it returning anytime soon. I could be wrong, but I don't see it.